Good afternoon, everyone. For those of you who I haven't met, I'm Peter Glenton. I'm a partner here at Rycroft Glenton. And firstly, thank you for joining us on this sunny day. I'm sure there's many other distractions, but it is very much appreciated you taking the time to attend. Um, so, just by way of brief summary of the plan for the webinar today. We aim to be as efficient as possible and to complete the webinar within about 40 minutes. We'll then allow time after that for you to ask any questions that you've got. If you can do that, please do type those into the chat box on the screen as you go, or just feel free to ask the question at the end of the presentation. So whatever works for you is absolutely fine. I'm joined today by my colleague, Anthony Main, who is a tax director here at Rycroft Glenton, and also Anne Slater Brooks, who is a regional director at Triple Point. Anthony and I will talk through the details of the inheritance tax relief available to businesses, which is called Business Relief. And Anne will be discussing the Triple Point investment vehicle, which enables investors to benefit from business relief. So before we start, can I ask each of you to answer the poll question that you should see on your screen now to let us know if you have significantly more cash in your business than you require for your working capital needs. And I'll explain the reason for asking this question if we move through the presentation.
No, at this seat.
All right.
Okay, so if we leave that there, thank you. So business relief is a valuable inheritance tax relief that is available to owners of shares in limited companies or interest in partnerships. So it's not just limited companies, it also applies to partnerships. But today we'll be talking about limited companies specifically. There's also a special exemption whereby business relief applies to shares in companies listed on the alternative investment market, otherwise known as AIM. But again, we won't be covering that today, but just for reference. Now, the business relief legislation provides 100% freedom from inheritance tax on the value of shares in an unquoted trading company on the death of a shareholder, so long as the shares have been held for at least 2 years prior to death and are still held at death. And the term unquoted, in English, that means a company that is not listed on a recognized stock market. So any owner-managed business would fall into that category. The complicated bit about business relief is that it only applies to trading companies, not investment companies. Now, it's important clearly to understand the difference between the two, and I would go on to say that that difference isn't always clear-cut. An investment company is normally a company that rents out property or holds an investment portfolio of quoted company shares or bonds or whatever. A trading company is one that sells goods and services. And the reason for the delineation between one qualifying and one not is that business relief was originally established with a view to protecting jobs, which is why it's targeted at trading companies, which typically employ people, and doesn't apply to investment companies, which tend not to have many employees, if any. Where it gets complicated is where companies have a combination of trading and investment activities. do they qualify for business relief? The current legislation states that business relief is not due where the business consists wholly or mainly of the making or holding of investments. And HMRC normally interpret mainly as over 50%. So that is the test. And the 50% test, we look at revenue, we look at assets, we look at net profit, we look at the number of employees engaged in the business as to what do their activities pertain to the trading bit, pertain to the investment side. But trying to pin down whether a company that has a mixture of trading and investment activities actually qualifies for business relief can be complicated. And unfortunately, HMRC will not give advanced clearance on the subject. It's always helpful to understand the context of legislation with a view to determining its ongoing relevance or otherwise in today's world. And this is particularly relevant today as we come up to the hotly anticipated and much feared Labour budget on the 30th of October. Business relief was introduced in 1976 by Wakefield, a Labour government. The reason for the introduction of the legislation was to ensure that after the death of a major family shareholder, a family-owned business could survive as a trading entity without having to be sold or broken up to pay death duties. Such a breakup or sale could put jobs at risk, which was a major concern during the economic stagnation of the 1970s. So there is some hope that business relief, or I would say actually, going to say more than that. I think there is very strong hope that business relief will be retained by Labour. The question really is whether they'll make any tweaks to it. Labour have made noises about wanting to be business friendly, and if they do want to last more than one term in power, they will need to be able to demonstrate economic competence. Small and medium-sized businesses make up the vast majority of employers in the UK. I think it's something like 60% plus of all jobs are from owner-managed businesses, SME businesses. And so any attack by Labour on business relief would, in our view, be unwise for that very reason. What they could potentially do is change the qualifying period. And I mentioned earlier that as long as you hold the shares in a trading business for 2 years prior to death, and at death they qualify, they could extend that period as one thing potentially, or they could require that much more than 50% of a business's activities to trading. They could, for example, increase that to somewhere close to 75%, 80% or something. But I think it's fair to say we at Rycroft Glenton would be very surprised if they abolish business relief outright. So what are we going to focus on specifically today? And the answer to that is two specific areas of business relief that we think you'll find useful. The first, which Anthony Main is going to cover, is how you can mitigate the loss of business relief when you sell your business. And Anthony's also going to discuss the concept of accepted assets, which pertains to having mostly excess cash on your balance sheet, which is why we asked that question earlier. And the second, which Anne Slater-Brooks will be covering, is how you can shelter any excess cash, accepted assets, within your trading business from inheritance tax. So I will now hand you over to Anthony.
Thank you, Peter. Good afternoon, everybody. Peter has asked me to start off with an overview regarding the impact on the availability of business property relief of selling shares in a qualifying company. As Peter mentioned, we're focusing on companies today, but for the avoidance of doubt, very similar principles apply to those of you who operate via a partnership. As a transactional advisory firm, we're involved in many business sales, and a company sale focuses one's mind on the immediate tax implication, capital gains tax and how to mitigate that tax liability. A tax that's often charged at as little as 10% for entrepreneurs, but otherwise currently caps out at 20% for most business sales. And I think you'll agree, particularly with the budget risk looming, those rates are relatively bearable for capital gains tax. But what often gets swept by the wayside in the excitement and anticipation of selling your company is inheritance tax, which at 40% is double, if not quadruple, the rate of capital gains tax a company vendor will spend so much time and energy trying to mitigate. That's totally forgivable. Capital gains tax is here and now, whereas inheritance tax is tomorrow's issue, perhaps someone else's problem. But with careful planning, it doesn't have to be. So you're a company owner and subject to the traps that Peter hinted at earlier, which are for investment businesses and around accepted assets. Throughout the life of your company, its value has probably been exempt from inheritance tax courtesy of business property relief. But the moment you sign the sale purchase agreement, that protection is lost. And it is worth emphasizing that the point at which business property relief is lost is when you enter into that unconditional contract to sell and not necessarily when the cash comes into your bank account. So you've gone from having a valuable asset that could be passed on inheritance tax-free to having a pot of sale money that's immediately, and I stress immediately, exposed to inheritance tax at up to 40%. And that is a very, very hard cliff edge. And just to try and focus our minds on this, I want to illustrate, if I have a company which is worth £5 million, I could pass that on inheritance tax-free at death, and then my beneficiaries could probably sell capital gains tax-free. But if I've just sold my business for £5 million cash, I'm probably going to have to pay something in the order of £900,000 in gains tax, leaving 4.1 million exposed to inheritance tax. And if the worst happens, I die, my estate could lose a further £1.6 million in inheritance tax, leaving only 2.5 million for my beneficiaries, compared to what would have otherwise been £5 million if I'd retained my company. This illustration focuses my mind, and I hope it helps focus your mind, on the importance of thinking about our capital taxes, capital gains tax, and inheritance tax together when selling your business. The next thing that Peter's asked me to talk around is replacement assets. So if you find yourself in a situation where you have sold your company and you have exposed wealth to inheritance tax, what can we do? Sometimes the loss of business property relief might not be a huge concern. For example, if you're young and fit. But if you do find yourself in a situation wishing you still had the benefit of BPR, for example, in an unexpected limited life expectancy situation, or where BPR would be helpful to facilitate some lifetime inheritance tax planning, which I'll come on to soon, you might be interested in a little known part of our inheritance tax code known as replacement property relief. This relief applies where you sell an asset which qualified for business property relief, so the shares in your company, and the relief acts to maintain BPR if the asset is replaced by the purchase of another new qualifying business asset. It doesn't have to be the same type of business asset. And as Peter mentioned earlier, various assets can qualify for business property relief. And Anne will come on to discuss her firm's offerings shortly. What you might be thinking, however, based on Peter's introduction, is that it's going to take 2 years of owning the new asset before it qualifies for BPR. But wonderfully, with replacement property relief, this isn't the case. The 2-year ownership period to qualify for BPR is not reset if the sale proceeds are used to purchase a replacement asset within 3 years of the sale of the original asset. So replacement property relief is fantastic. If the original asset qualified for BPR, business property relief continues to be available if the combined ownership period of the original asset and any replacement asset covers at least 2 out of the 5 years immediately before death, hence selling now and having to reinvest within 3 years. So how can replacement property relief be utilised? For someone having sold their company, they could reinvest some or all of the sale proceeds into qualifying replacement property. And as I mentioned, as long as that reinvestment is done within 3 years of sale, they achieve immediate continuity of business property relief, despite perhaps having owned investment assets during that interim 3-year period. It's almost like being able to flick a switch to turn the inheritance tax exemption back on, as if it were never lost. As I mentioned, this can be a hugely valuable option if there's an unexpectedly short lifespan situation after a company has been sold. But the replacement property provisions can also be used to regain access to some of the pre-sale planning opportunities that we would suggest if they have been missed. In terms of pre-sale planning, business property relief allows us to move assets, including company shares, from the current owner to someone else with fewer restrictions, particularly without triggering a capital gains tax liability. Normally, gifting assets, including company shares, is a deemed disposal for capital gains tax. In the run-up to a company sale, we'll spend time with our clients looking to mitigate not only capital gains tax, but exploring options to mitigate their instant cliff-edge increase inheritance tax exposure. Where sale proceeds are significant, we'll often challenge our clients to consider whether the wealth generated is needed by them, and if the answer is no, then we can offer some practical and pragmatic suggestions. Otherwise, if that excess wealth is left with them, it's storing up inheritance tax issues for the future, and those issues become more difficult to deal with as one's age increases. In this scenario, many of our clients have made use of a discretionary trust to manage and mitigate their and their family's future inheritance tax exposure. Broadly, before their company is sold, we establish a discretionary trust into which our client gifts a number of shares. As long as the company doesn't fall foul of the traps that Peter flagged earlier, we can generally transfer shares with unlimited value into the trust free of inheritance tax and free of capital gains tax, so that there are no transactional tax costs to this step. And without the benefit of inheritance tax business property relief, we would generally not settle more than £325,000 of value on trust, or else lifetime inheritance tax would be charged. This emphasises the importance of acting when BPR is available. When the company sells, the trust gets its share of the sale proceeds. It pays capital gains tax, usually at the same rate our client would have, so there's no additional tax leakage. But crucially, the value of the trust's cash, which is no longer protected from inheritance tax, sits outside of our client's estate. A really neat planning point to add in here, particularly for high or fast growth businesses, is establishing this sort of trust arrangement maybe 12 or 24 months before a sale or exit is likely. At that earlier time, we can often argue that the company's value overall is lower, and then we can also apply a minority discount to the shares being gifted into trust. In short, and using some arbitrary numbers to illustrate the point, if I give shares with a discounted value into trust now, worth maybe £100, and in a year's time they sell for £1 million, there's a huge inheritance tax benefit, particularly if I don't survive the gift for 7 years, which is because the value of the property potentially falling back into my inheritance tax estate under the PET provisions is only £100,000, so the value that I gifted, and not the £1 million realised for the shares. That's £900,000 I've kept outside of my estate, and a potential £360,000 inheritance tax saving. Trusts do have their own inheritance tax regime, so they're not a complete safe haven, but the trust regime is much lower, and the trustees themselves could take steps to invest money in inheritance tax efficiently to mitigate exposure at relevant times. In terms of the discretionary trust planning we undertake with our clients, replacement property relief can be valued to the trustees as well. If the settlor of the trust, our client, dies not having survived 7 years from creating it, the trustees would face inheritance tax exposure on the assets they hold. But should the trustees have reinvested the company sale proceeds into qualifying replacement property, it's likely that the inheritance tax exposure coming about from the settlor, our client's death, would be reduced or vacated. This isn't an absolute fail-safe because the window to use this planning is probably 4 years from the time the company is sold, so it may not necessarily cover the full at-risk 7-year period associated with inheritance tax. If you've already sold your company, but 3 years haven't yet passed, the replacement property provisions can help switch BPR back on to undertake some of the pre-sale planning I've just mentioned. The second area, or third area, that Peter's asked me to comment upon is the accepted assets provisions. Now, it was interesting, I did have a quick look at the poll results, and it seems that about half of you feel that you have too much cash on your balance sheet, and about 8 or 10% don't know the answer. And that is really telling. The accepted asset provisions are complicated. It's perfectly possible for your company to qualify for BPR, whilst at the same time not benefiting from a full exemption from inheritance tax. And this is where the concept of accepted assets bites. These are assets owned by your company that aren't currently used in the business and aren't required for immediate future use in the business. And typically, surplus cash is the most problematic accepted asset we come across, where company owners have diligently managed their business, allowed cash reserves to build up, perhaps to avoid income tax on extraction of profit from the company, to the extent that some of the cash reserve isn't required as working capital, or it isn't earmarked for a specific purpose such as asset acquisition or expansion. If you've got large cash reserves, it's critical to keep detailed records as to why they are needed in the business's trading operation. As I mentioned, this is a difficult area. It's a very grey area and of keen interest to HMRC. Alternatively, if the cash is genuinely surplus to trading requirements, it can be repurposed and brought into a qualifying trading activity, which is something Anne will discuss in a moment. And this can often be a very quick fix, often being fixed immediately and without the 2-year wait associated with BPR. So you can take the cash on your balance sheet and bring it into qualifying use instantly. Along a similar vein, not quite an accepted asset scenario, but what about an investment company that doesn't satisfy the wholly or mainly test to qualify for BPR? It's the test that Peter mentioned earlier. A company that is mainly one of making and holding investments, perhaps a family investment company, or a company that has gone through a trade and asset sale. It essentially becomes an investment company and won't qualify for business property relief into the future. However, it is possible to turn an investment company into a trading company that will qualify for BPR, and quite possibly with immediate qualification, as long as the investment company shares have been held for 2 years or more. Now, this is a little bit racy in terms of tax legislation, but what the rules say is that once you meet the 2-year ownership test, if the activity of the company is trading at the relevant time, death, then business property relief can apply, even though the company may not have been trading throughout the 2 years before death. Now, converting investment assets into a trade will require some thought around corporate capital gains in the company, but arguably this also offers some great options around short life expectancy situations where there is a significant value in an investment company, or options to move wealth into an investment company to take to the next generation tax efficiently. Now, that brings us on nicely to consider what qualifying replacement property might look like, and indeed what business property can look like, which is where I'd hand over to Anne, and she can tell you more about Triple Point's offering.
Fantastic. Thanks ever so much, Anthony, and thank you for joining us all this afternoon on a lovely sunny day, it looks like. So just a very quick introduction to myself and Triple Point. I'm regional director for Triple Point, possibly a name that you won't have come across before. And that's because we're an investment company that does not market direct to consumers. So we only deal with financial advisors who then recommend our products on to people like yourselves. And actually, that's incredibly important because fundamentally, these are quite complex solutions, and therefore you absolutely do need the advice and the support of people like Anthony and Peter when it comes to determining whether these are the right solutions for you and your businesses. So I'm actually going to pick up where Anthony left off, and I'm going to start with an example around accepted assets, but I'm going to bring it to life with a case study. So if I start with Henry, who owns his own business, and as you can see, this business is comprised of £1.2 million of trading assets and 800,000 of cash. So in total, the value is £2 million, very simplistically. Now, if we go back to what Peter was saying about the wholly and mainly trading rule, we can see quite simply in this situation that the £1.2 million of trading assets exceeds the 50% of the overall value. So on the face of it, we've ticked the box to satisfy the wholly and mainly trading rule, and therefore some business relief would be applicable. However, the question mark is around the £800,000 of cash, because as Anthony has just indicated, HMRC may not accept that all of that is working capital and is needed for the business, particularly if it has accumulated over quite a long period of time and there's no indication of what its use is intended for. So it's possible in this scenario that HMRC could aim to attack some, possibly all, but probably some of that £800,000. Which the worst case scenario is you would have a 320,000 tax liability, but we'll maybe come back to that point in the Q&A, Anthony, because it'd be good to touch upon what might be deemed acceptable. So that's definitely where these solutions can come into play. But what if I turn this around? So again, Anthony alluded to this type of scenario. So the same business, it's worth the same amount, it's still £2 million, but now we've got £800,000 of trading assets and 1.2 million of cash. So you can see that the pendulum has swung from satisfying the wholly and mainly trading rule to no longer satisfying it. So although the cash has gone up by 400,000, the tax liability potentially has gone up by 480,000. Because the entirety of this business is unlikely to qualify for business relief at that point. And this is a classic scenario where an investment company could benefit from the types of solutions that we can offer to clients. We do come across quite frequently companies that are close to that threshold as well. So I think it's really important to emphasize, and those poll results really highlighted this, just how important it is to seek advice if you're not sure whether you've got an issue, or certainly if you think you've already got an issue, because there is such great planning that can be undertaken in those instances. So if I just show you an example of how this could change in a second, but first let's just have a look at 3 options for this business owner. So Henry really can do one of 3 things to address this issue. So the first is he could take the money that's currently sat in cash and use it to do further trading activities of his own. That might involve buying a new business, all sorts of other things. And ultimately that could work for this client, but it might not be in line with what Henry is trying to achieve for himself. So if Henry is thinking that he might want to exit from this business in the coming years, he might not be overly keen at the prospect of getting involved in another business interest. So whilst that would work, it's a question of, is it aligned with his goals? The second option, which is probably the least palatable, and if many of you are business owners, you will obviously have this dilemma yourself, is extracting money from the business, and what is the most tax efficient way to do that? So clearly you can extract it as dividends, you could extract it as salary, bonuses, etc. But if we think back to that previous example where there's 1.2 million in cash, Let's just suppose that you were to think about extracting £1 million in this way. You're looking at quite a sizable tax bill just to get the money out of the business. So the tax bill in respect of dividends is going to be just shy of 40%. The tax bill in respect of bonus or salary would be just over that 40%. In which case that becomes quite unattractive if you're paying 40% tax to effectively save 40% tax. That might not be that appealing to many business owners. The third option, which is the one that a lot of companies tend to be less aware of, is that you can effectively achieve the same outcome as number 1 point, i.e. you can turn that cash into trading activities, effectively using investment products, I'm going to call them. The reality is legally there's no difference between the two, but companies like Triple Point market solutions where you effectively have an interest in a trading partnership, but you don't get involved in the day-to-day management of that business. So we effectively undertake that on your behalf so that you can take advantage of business relief. So if I just show you what that might look like for a specific client. So if we go back to Henry, same scenario as before. He's got 800,000 of trading assets and 1.2 million pounds of cash. So currently at the moment, this business is not satisfying the wholly and mainly trading rule. However, if we take £800,000 of that cash and deploy it into a trading partnership, and I'll explain in a second a little bit what that looks like, you can see that that £800,000 added with the other £800,000 of trading assets now is equal to 1.6 million, which is very clearly over that 50% threshold that Peter was referencing before. So we've now effectively given back the company the wholly and mainly trading rule satisfaction. So we've reintroduced we've reintroduced business relief. And exactly as Anthony said, as long as Henry has owned the shares in his business already for 2 years, that does not carry a new 2-year clock. That is effectively an overnight situation. So in this instance, we've effectively protected that business from a sizable amount of inheritance tax. Now, we've still got £400,000 in cash, so there is a possibility that HMRC would still view some of that as accepted assets. And a bit like Peter said about the wholly and mainly trading rules, there's all sorts of factors that they will take into account to determine what amount they would deem acceptable. And we can perhaps talk about that in the Q&A. But you can see even in this scenario where we've just taken 800,000 and put it into a trading partnership, that is effectively going to save this business 320,000 on those funds, plus the 320,000 on the trading assets that we're trading anyway, because the pendulum has swung back to satisfying the wholly and mainly trading rule. So hopefully that makes sense. I'm literally just going to give you a very quick overview of our solution, just in case any of you are thinking, well, what would that look like? So there's quite a lot on this slide. So before I get into some of the detail, I'm just going to give a very brief overview of what our overall solutions that are business relief related effectively do. So when your business or you as an individual invest into a business relief solution at Triple Point, ultimately that trading activity is a lending and leasing business. So I always say the easiest way to describe it is what we do is a little bit like what a bank does. You go put your money on deposit with the bank, you get a rate of interest, the bank uses your money to finance lots of individuals and businesses throughout the UK. What we do at Triple Point is very similar, except clients are coming to us to get the inheritance tax saving, but fundamentally we use the funds that we raise from that activity to effectively finance thousands and thousands of organisations and businesses in the UK. And you can see here there's 2 partnerships referenced. So they both do the same thing, but there's a difference in target return because of who they lend and lease to. So on the bottom, you've got Triple Point Lease Partners. this particular partnership lends and leases to the NHS, local authorities, the public sector, large corporate clients. And that's reflected in the target return, which you can see there is 2 to 4% after annual charges. So it's a modest target return, but everything we do is very much about ensuring consistency of return, and we're trying to preserve the capital that you've spent your life possibly trying to accumulate. Generations Navigator, you can see above, has got a higher target return of 4 to 8% after annual charges. And that's because that's lending and leasing to small businesses throughout the UK. So precisely with those businesses that Peter was mentioning at the outset, that 60% of the UK population working in SMEs, we provide finance to companies like perhaps your company if you are running your own business. Obviously, it's a higher target return because naturally smaller companies will pay more for their finance than what the NHS would do. And on the right-hand side, there's a lot of numbers on there, but essentially all that is really saying is you can mix and match these two partnerships to suit your interests, what kind of target return you're looking for. And that just gives you an indication that if you did 50-50, for instance, you might be looking at a return between 3 and 6%. It's probably worth me sharing at this point something else that is worth just mentioning, really. I did some research recently for a presentation I was doing, which was on a completely different solution that we offer, but it's a corporate solution. And what I found off the back of that research is there's about 150 billion of money sat on deposits in corporate bank accounts that is earning nothing at all, which really shocked me. So I think there's about 275 billion of corporate money on deposit, but the vast majority of that money is earning nothing. And that's probably because you're busy running the business rather than looking after the money and trying to get the best rate of return. So actually, these solutions, notwithstanding the inheritance tax benefits, could potentially help you to make that money work a little bit harder for the business as well. But just to touch very briefly on past performance. So these are just the charts of the performance of each of the partnerships. And there's a couple of things to highlight. So the bottom line on each of them is the lower target return. The upper line is the upper target return. And then the line through the middle is effectively what these solutions have done. And I always like to emphasize with the line, just the consistency of that line. And what you can really clearly see there is that they do what they say on the tin. So it's very consistent performance. You've not got volatility like you might typically think when we're talking investments. And that is really the nature of the underlying trading activity that points to that. And the last thing I would say is you can see there, we've been doing these solutions since 2006. So we're not far off the 20th anniversary. And in that time, we have never, ever lost a client a penny. So obviously, we will have all lived through all sorts of different economic things going on in the last 20 years. And I think it's fair to say that's an impressive accolade in terms of the returns. And that's on top, obviously, of the inheritance tax benefit. So that brings me to the last poll, which is just in relation to the other scenarios that we were talking about. In terms of I feel like, Anthony, I feel like something's gone really strangely wrong with my slides there and I've missed something out. But are you thinking that as well?
No, I think that was the end of the slide deck.
Okay, that's fine. I thought something really strange had happened. Apologies there, people. So yeah, this question is very simply, have you sold a business within the last 3 years? I would also perhaps suggest that if you're thinking of selling a business, you perhaps put a yes, because you may benefit from advice as well. We'll just give you a minute to respond to that. Fabulous. I think that's everybody. So it definitely looks like there's a lot of you on this call that could benefit from speaking to Peter, Anthony, and so on. I'll just get the poll out of the way. And Peter, I think I'm passing back to you in terms of the question time.
Indeed. Thank you, Anne. Thank you, Anthony. And thanks to all of you for listening through that. I hope there have been some nuggets of interest in there. So, yes, moving on to questions. I'm just having a look to see if I can do that. I don't think there's anything in the chat box there. But please, if any of you do have any questions, could you ask them just switch on your video. Anthony, you put your hand up.
I have. I don't want to put you on the spot, Anne, so apologies in advance. When I've spoken with my clients about TriplePoint's offering, one of the questions that I'm often asked is how liquid is, I'm hesitating to use the word investment, but how liquid are the funds, and what's the timeline if somebody wanted to get their funds back because they did need capital for a trading purpose?
Yeah, it's a great question, Anthony, and actually lots of people do ask that, so I think it's a really worthwhile one. The answer is it really depends on whether you're investing into our personal business relief solution, which might be if you were taking advantage of replacement business relief, and that's typically about a week. Now, in that instance, we're selling a business interest, and you might say, well, how on earth do you do that within a week? But the reality is the nature of our underlying trade, being lending and leasing, means that in any given week, month, there's always thousands of deals, if you like, that are coming to an end. So in a typical year, we have about 250 million of assets that return to us, just with loans and leases coming to an end that provide liquidity. But equally, we're raising about the same amount of money from people that are wanting to save in everything tax. The corporate side of things is slightly different because the valuations take place quarterly. So in that instance, it's between 3 and 6 months, and it depends on when in the quarter they made the request. So if you made the request on the last day of the quarter, you'd be looking at 3 months. If they made the request on the first day of the quarter, you'd be looking at 6 months, because it's always the end of the quarter plus a quarter, if that makes sense.
Yep.
And it's not because there's a difference in terms of the underlying strategy, it's just the valuation on the partnership interest is a different timeline.
Alice, you've got a question.
Alice, yeah.
Alice, you're on mute, sorry.
Mute, yeah. Such an error there, wasn't it? Schoolboy error. Hi there. Thank you for that session, very informative. Just a good question, just leading on from what you were saying, Anne. For my clients, if we were, I was just sort of saying, you know, generically that there's this sort of option, what time frame do you think would be appropriate for them to be looking to tie up cash? Because there may be circumstances where, you know, they might be looking for business premises, but it's a year, 18 months, it could be 6 months. That they want to back that cash for.
Alice, can I replay that question to you? Because I don't know whether it's my signal, but you were disappearing a little bit for me. So I think the question was on the lines of, is it how long they should tie the monies up?
Yeah.
I'll answer that question, but if I don't answer the right question, please pop it in the chat box, Alice. So it's not one that's easy to answer, to be fair, because it really does depend on each individual client. So although these are not investments as such, you're basically taking an interest in a trading activity, hence the reason that they don't qualify, hence the reason why they're not viewed as investments by HMRC. Ultimately, how long you would tie things up would really depend on what the client's requirements are. Now, typically, I think it's fair to say that anybody advising on this type of thing would usually say, and it's probably more a question for you, Peter, but I think it's fair to say you'd probably say 5 years, would you?
Yeah, I think it's a fair point, Alex. I think obviously it's cost associated with going into this, and I think and then you've got the risk factor albeit as Anne has demonstrated, Triple Point actually has delivered very, very good risk-adjusted returns in terms of the consistency of this because of the nature of what they do. So we wouldn't really recommend it normally for anyone if they didn't have a minimum 5-year view. And I think the point being there almost answers this different question that Anthony not posed, but sort of covered off earlier, which is if you have got a clear plan to use that cash in the business within 5 years, then that's documented, covered at board meetings, evidence that you're trying to use it. I've got a good example of a farming client looking to buy land, and they had been looking for 10 years. They finally put a bid in and had that accepted a month ago. So we've always had that documented. So I think you would only go for the Triple Point option if you really didn't have any plan to use that money genuinely in the next 5 years plus.
Yeah, and I would definitely echo that because there are costs involved in setting them up. So it wouldn't be ideal if a client opted for this route and 6 months later said they need the money back, because they wouldn't be better off in that situation. However, I suppose the joy of these solutions is that if circumstances change, and clearly that could be the case, you can get the money back if need be. And actually, we did have a client that invested that had sold out of a business, so they did take advantage of replacement business relief. I think they were in for about 3 years, and they actually ended up withdrawing because they decided they wanted to buy another business. So they took advantage of replacement business relief again.
Thank you. That all makes sense, and so it's very much I can imagine it being a long-term plan that someone says, actually, it's not appropriate for me to extract the money out, as saying tax implications of that, but also don't want to sort of prejudice the relief in the meantime. So thank you for that, and apologies about my network.
I think, Alice, the point where it becomes short-term would be deathbed planning. So you have someone who has a terminal diagnosis. And remember, the point being that as long as the business is a trading business, or even potentially if it's an investment business, you put, as soon as the money lands into Triple Point, and if the shares have been held for 2 years, you get the exemption from inheritance tax. So that would be a good example as well. You've got a really short-term plan, but it's worth doing because you're saving 40%.
Yeah, that's a great example for that. Peter, it's like you teed me up with that one, because we actually had a scenario that is really similar to what you've just described. So this is going back a few years ago now, but we had a client that was terminally ill. He had a company that actually had always been a property investment company, so it never qualified for business relief. But he'd had it for 20 plus years. He knew he was ill. So he'd started selling off all the properties, and he ended up with a company that was wholly cash. And effectively, he deployed pretty much all of it, which would be quite unusual, into our corporate business relief solution, and he passed away 2 months later. But because he'd held his shares in the business for over the 2 years, and they were trading at the point of death, HMRC accepted that relief applied, and the family saved millions. It was fantastic advice in that scenario.
Okay, thank you, Anne. So I'm just looking at the questions in the chat box, and this is Geraldine's question. It'll be one for you, Anthony. So if you've got a business that is a trading business that has substantial cash on the balance sheet, but that cash has been invested into investment portfolios managed by a discretionary manager, would that be an accepted asset, or would that fall within the trading rules as being part of the business activities of a company?
That's thank you, Peter. That's a very difficult question to answer off the cuff and concisely. Typically, if it's a portfolio of investments under discretionary management by a third party, I would be concerned that HMRC would view that as an accepted asset. If you had the company's directors actively involved in the management of an investment portfolio, then we could have an investment business sitting alongside the trading business, and it wouldn't necessarily be an accepted asset, but we'd have to look very carefully at the wholly or mainly test, and if the investment assets were worth more than the trading assets, the director spent more time on the investment business generated greater profit, then that might tip the entire company to being one that isn't wholly or mainly trading and one that is mainly investment, and you would lose BPR on the entire value of the company. So a bit of a risk. It's not an absolutely binary answer, but I would generally look on a discretionary managed investment fund as being an accepted asset.
Anthony, just to follow up on that as well, I think there's something in the accepted assets, and this is definitely your sphere more than mine, about the 2-year rule. Like, did you use it in the last 2 years, or are you planning to use it for something in the next 2 years, I think? And given generally with investments, say an investment bond, DFM, we typically, you should be willing to tie it up for 5 years.
Yeah.
Straight away, there's a bit of a conflict, I think. So I would definitely agree with what you said there.
Yeah.
Thank you, Anthony. So the next question from David Lim. So if you're investing cash that's earmarked as a rainy day fund in a relatively less liquid investment product, so for example, a 180-day notice account, how much more likely will this amount be deemed as surplus to trading and thus not qualifying for business property relief compared to it if you kept that cash in instant access? Anthony, to you.
Thank you again. In this instance, I do see the difference between the two options. I wouldn't like to say that having it on instant access is a get out of jail free card, nor is having cash on a notice account necessarily the death knell. What I'd be advising and what I would want to see is probably a specific earmarked use for the cash rather than just a generic rainy day fund. My experience with HMRC is they're not particularly affable to rainy day funds generically. So I'd want to see the cash earmarked for specific purposes, and I'd want to see detailed director's minutes and that sort of thing, demonstrating that these funds are earmarked for the following purposes. Give you a fantastic real life example. We're working on a case that we were asked to step into a trading company with £6 million cash on the balance sheet. Unfortunately, the only person that really knew what that cash was for was the 50% shareholder director who died, sadly. And we have had to try to reconstitute with our general business heads on what that cash might have been needed for at the time of the shareholder's death. That cash is on an instant access account. As Anne mentioned earlier, it hasn't earned a penny of interest in about 4 years, £5 or £6 million earning nothing, sat on instant access. We've put together a robust argument supporting the need for that cash. HMRC couldn't care less whether it's on deposit or available instantly. For them, it's very much, what is the cash needed for? Was it needed at the time of death in the company, working capital, earmarked? Was it needed in the immediate future? And it's that immediacy that often trips people up. As Peter said, we have clients where money has been set aside for acquisition and expansion, and it might have sat there for 10 years looking for an appropriate target. That's one of the arguments we've deployed in this particular client's case, but we have very little evidence, and evidence-based responses to HMRC always win, as distinct from hypothetical answers. So, yeah, it might help your argument to have cash liquid, but it's not going to be rock solid.
I think the thing I would add to that as well, Anthony, is that ultimately this is the stuff that you can plan to mitigate. But obviously it's tested on death, isn't it? And as you identified there, once it gets to that point, it's quite difficult to overcome it if there is an issue. So it's better if you do think that there's possibly an issue to get the advice now, try and do something about it beforehand.
Sorry, thank you, Anne. I don't think there's any more questions, no more questions in the chat box. Does anyone else have any questions before we finish off?
So I've just got the feedback poll, which I'll bring up. Peter. And obviously, if there are any more questions, please keep putting them in the chat box. But we'd love to know what you thought of today's session and whether there's anything else that you would like to hear from Peter and Anthony from in the future.
Thank you. So thank you all again for attending. Really appreciate it. And if you have any questions at all or just want any discuss any follow-up points, please don't hesitate to contact either me or Anthony or Anne, or you can come through Anthony and me for Anne as suits. So anyway, enjoy the rest of the day. I hope the sun is shining where you are. It is outside my window, and make the most of it before we hit the autumn. So thank you very much again, and goodbye.
Fabulous. Thank you.
Bye.
Take care. Bye.